The Big Short, Michael Burry, recently released his 13F filings, and it's creating quite a buzz. In this episode, we'll reveal what Burry is betting on and explore the potential implications it may have on the market. So get ready for a captivating analysis that might just reshape your investment strategy. So did you know that Michael Burry, the well-known investor and hedge fund manager, was trained as a doctor? He received his medical degree from the Vanderbilt University School of Medicine in 1997 and practiced medicine as a neurology resident at Stanford Hospital. However, Dr. Burry transitioned from medicine to finance and became famous for his early recognition of the housing bubble and subsequent crisis in the Great Financial Recession in 2008. He made savvy moves by going short and profiting when stock prices plummeted. Sure, he also made money during the market rebounds, but his real claim to fame lies in his ability to predict crashes. That's why everyone is so interested to find out what or when his next big short ideas will be. Apart from the interviews he conducts, everyone is keeping an eye on his 13F filing to get a clear picture of what he's up to. A 13F filing refers to a mandatory disclosure document that institutional investment managers in the United States with over $100 million in assets under management are required to submit to the Securities and Exchange Commission. The 13F filing provides detailed information about the investment holdings of these institutional investment managers, including their positions in publicly traded stocks and convertible securities. It offers transparency into the portfolio holdings and investment strategies of these large investors, allowing the public and other market participants to track their activities. It is typically filed on a quarterly basis within 45 days after the end of each calendar quarter. Now, there are some limitations in the 13F filings. These filings only cover US publicly listed stocks, leaving us in the dark about what Burry might be holding on non-US exchanges. Plus, these filings only reveal long positions. If Burry has any short positions, which he is known for, well, tough luck, we won't get to know about them. Thirdly, the filings do not contain information on bonds or certain derivatives like options. But despite those limitations, it is still a valuable tool for retail investors like us to see what those big guys were doing. Now, let's look at what Burry is actually doing with his portfolio. If we compare last year's data to the most recent filings from Scion Asset Management, which is the fund Burry manages, it is interesting that his equity positions have steadily increased over the last year. In the first 2 quarters of 2022, he had almost no long positions at all, but he gradually built them up, and now he's sitting on over $100 million in long positions. So he has been buying more stocks as the market declined. Quite interesting, right? When we take a closer look, we can see that Michael Burry is not only buying stocks, he is buying stocks that have been hammered hard in recent market turmoil. From this table, we can see that he has established long positions in several US regional banks. The same regional banks that have been caught in the storm and are feeling the heat. 4.15% of his portfolio is invested in Western Alliance Bancorp. 2.3% of the portfolio is in PacWest Bancorp. Another 2% of the portfolio in First Republic Bank. He also has large positions in Capital One Bank and Wells Fargo. His largest bank position, New York Community Bancorp, comes at 7.2%. And together, Michael Burry has allocated more than a quarter of his portfolio in the banking sector alone. Now, we won't know for sure if Michael has short positions or options betting against these financial stocks, but it is probably safe to say that Michael Burry bought those beaten-up stocks for a rebound in the days to come. His 13F filing at the end of 2022 didn't show he took positions in these stocks, so he loaded these long positions in the first quarter of 2023. The rationale being he probably selected a basket of financial services companies he believed that had big upside and invested in this basket of said companies. We won't know how long he held those positions or if he even chose to sell when he exited those positions. But we do know that not all of his bets worked out. For example, First Republic Bank went belly up in early May, so it is likely Burry's bet there did not work out. But on the other hand, New York Community Bank Corp is up about 20% year to date, showing some serious rallying power. If we take a look at the sector breakdown, we see that financial service and consumer cyclical are the most concentrated sectors for Michael Burry. Over half of his portfolio is invested in those sectors. The next big sector he is betting on is technology, which comes in at around 11%. Energy sector also has a heavy position at around 9%. So what does the positioning tell us? Well, one possible answer is that Michael Burry is betting on an economic recovery taking place in the months to come. Because, consumer cyclicals and energy prices both tend to do well when the economy is booming. Here, we are looking at the individual stocks in Michael Burry's portfolio. It is a bit surprising to see that two of his biggest holdings are Chinese stocks, JD and Alibaba. We can see that JD and Alibaba together account for another 20% of Michael Burry's portfolio. JD primarily operates as a business-to-consumer online retailer, offering a wide range of products, including electronics, home appliances, clothing, books, cosmetics, and more. Importantly, JD.com has a comprehensive logistics network and owns and operates its own warehousing and delivery infrastructure, enabling it to provide efficient and reliable order fulfillment and delivery services. But if we dive into the recent quarterly earnings report of JD.com, it's not painting a rosy picture for the stock. The revenue growth over the past year stands at a measly 1.4%, possibly the lowest it has ever been. Adding to the concerns, the company has a capital-intensive business model, and therefore it is a low-margin business with its EBI-TDA margins remaining below 3%. So far, the fundamentals aren't indicating a quick turnaround story for JD.com. Meanwhile, Michael Burry's other Chinese stock, Alibaba, is a multinational conglomerate and one of the world's largest e-commerce companies. It operates various online platforms that facilitate B2B, B2C, and C2C sales. Recently, shares of Alibaba have remained under pressure despite the company generating rather robust revenues. The stock's valuation has been compressed to a very low forward PE ratio of about 9.5x. Michael Burry is likely betting on the stock's valuation levels normalizing as we advance, which sounds like a reasonable investment case given Alibaba's excellent financials. In fact, valuation for Chinese stocks are currently quite low. If we compare the forward price-to-earnings ratio of MSCI China to that of the United States, it is noticeably lower. Additionally, when comparing China's forward price-to-earnings multiple to its own historical data, it appears undeniably cheap. So that may be the reason behind Michael Burry's concentrated allocation into those two Chinese stocks. Still, the e-commerce market in China is fiercely competitive and saturated with narrow profit margins. On top of all that, there's a constant stream of promotional offers to entice people to spend, which further eats into profitability. So it's a little bit surprising to see such a concentrated position in this sector and those specific stocks. Sentiment in Chinese stock market is currently pretty low. Burry must have immense faith that they're the golden tickets to ride the China wave. Now, the question arises, should we follow in Burry's footsteps? While it's fascinating to analyze his moves and try to decipher his reasoning, blindly copying his trades may not be the best approach. Remember, the 13F filings are released 45 days after the prior quarter end, so the information we are seeing here is not the most up-to-date. More importantly, his circumstances and investment strategy are quite different from ours. It's essential to consider our own financial situation, risk tolerance, and investment goals before diving into any particular trade. What we can take away from this analysis is that Michael Burry is bullish on the economy and on stocks. And there you have it, folks. The fascinating world of finance never fails to surprise us, and Michael Burry's latest bet is no exception. We hope this video shed some light on his investment choices and provided you with valuable insights. If you enjoyed this video, don't forget to hit the like button and subscribe to our channel for more thought-provoking content. Feel free to share your thoughts and comments down below. Until next time, happy investing and stay tuned for more exciting updates.